Every time I explain how I have clients who have paid zero in taxes, my comment section on my Instagram goes wild. You're a scam. Enjoy your audit. You don't even know what you're talking about. But here's the reality. Trump's new tax bill just made it even easier for the wealthy to get richer, while most Americans keep overpaying in taxes. So if you're a business owner, high net income earner, or real estate investor, in this video today, I'm showing you exactly how this works using the 3 tax codes that most people don't understand. My name is Anna. I am a licensed CPA and tax strategist. And before you roll your eyes, hear me out. I don't teach people how to cheat the IRS. I teach them how to beat the IRS at its own game. Because here's the truth, you guys. The tax code is literally written with loopholes and incentives for business owners, investors, and wealthy people. That's why the wealthy people pay less in taxes. My clients, real people with real businesses, real jobs, have legally saved millions in taxes using strategies like the Augusta Rule, the S-Corp structure, and the short-term rental loophole. If you've ever wondered how rich people keep getting richer while you're stuck paying more in the rat race of the tax code, this is it. And my mission is to show you how to use the exact same rules without stress, fear, or guesswork. So let's get into it. Here are 3 controversial but legal tax codes that could change your entire financial picture if you know how to use them correctly. The first one, the Augusta Rule, Section 288G of the Internal Revenue Code. What the heck does this do? This allows you to rent your personal residence for up to 14 days a year and pay 0 taxes on that rental income. So how do business owners take advantage of this? If you have an S-Corp, your business can legally rent your house for business purposes, such as team meetings, board of director meetings, video shoots, podcast recording, client retreats, tax planning days. So let's say that you charge your business a fair amount in the city that you live in, and it's $1,000 a day. You can do this once a month the entire year. That's $12,000 that you can deduct from your business and transfer it to you personally. And guess what? You don't even have to claim it on your tax return. Now let's talk about documentation, because you do need to have some of that and it needs to be legitimate. You need to have a formal invoice as a owner to your business of a fair amount of rent. What you can do is contact a local office around your area, because the rent income in Austin, Texas is completely different than the rent income in a small town in Nebraska. You call them, you get actual documentation of what a legitimate average would cost, and you invoice your business. Now, you also need to have documentation on what the purpose of that meeting was. Was it a board of directors meeting? Do you have your minutes for that? Are you having a quarterly call with your top VIP clients? You want to do that. Are you having a recording podcast? You want to make sure that you document that. So where did this strategy come from? When I tell you that the rich people make the rules for rich people, this is exactly why. This actually started in Augusta, Georgia at the Masters in Augusta, Georgia. I'm assuming lobbyists said, hey, we own these houses, they're really expensive and we can rent them out, but I don't want to pay taxes on it. So they got together, drank some tequila and said, let's make this new tax loophole. So yes, the IRS knows about this. This strategy alone has helped some of my clients generate over $10,000 in tax-free income every single year. But it only works if you have proper documentation. By the way, I did make a full video breaking down how to actually use this. So I'll put it on here so you guys can click on it and get the full detail on that. Let's talk about number 2, the S-Corp strategy. This one is huge. If you're making more than $50,000 in net income in your business, so after all expenses, you're netting $50,000. And if you're filing still as a sole proprietor, you're overpaying in FICA taxes by a minimum of 15.3% of self-employment taxes. That's on everything you earn. And then on top of that 15.3, you're going to pay your ordinary tax rate, whatever that income is with your spouse. If you're married, you're going to end up paying that. And that's only federally. So let's break it down with an example, right? So let's say your net income is $100,000 from your lawn business. You're paying about $15,300 in self-employment tax alone. Like I said, that's before your other income kicks in. Now, let's say you switch to an S-Corp. You pay yourself a reasonable compensated salary, like $40,000. You will only pay that self-employment tax of 15.3 on $40,000 instead of the full 100K. The other $60,000 can either be distributed or you can leave it in the company. This strategy can save you $7,000 to $10,000 every single year, depending, of course, on the income that you make. And this is all IRS approved. In fact, they expect you to do this if you're a profitable business owner. Here's the catch, though. You have to file a separate tax return, an 1120S. You also must run payroll if you're a 2% owner and are active in the business. And you need to set your salary to what is reasonably compensated to somebody else who had the same job elsewhere. And here's something most people don't know. Single member LLCs filing on Schedule C have a higher audit risk than S-Corps. So switching to an S-Corp is not only going to save you taxes, but it may also help you stay out of the eyes of the IRS. This isn't aggressive tax planning. It's smart, legal, and completely defendable. And when you combine that with the Augusta rules, the tax savings start stacking on top of each other and they become even higher every single year. Now, I also recorded a very, very detailed video on what is an S-Corp, when should you have one, how to file right here. So I'll leave it here for you guys to watch. Let's talk about the short-term rental loophole. Guys, this one is so powerful, especially if you are a high W-2 income and cannot qualify for real estate professional status. So let me walk you through how this actually works. If you meet the following two requirements, the losses from your short-term rental can be treated as active losses and can be used to offset your active income from your W-2 wages. The two requirements are as follows. Number one, the average guest stay must be 7 days or less, so you must be turning people like a hotel. Number two, you must materially participate in the rental. There are a few ways to meet the number 2 rule, which is material participation. There's usually actually 7 tests, but the most common ones that my clients meet are you spend 100 hours more than anybody else in the property managing it, or by spending minimum of 500 hours managing the rental property or the Airbnb in this case. Now, here's where the magic happens. If you qualify under these 2 rules, you can do a cost segregation study. And now, because Trump's big, beautiful tax bill, it is back to 100%. So you can write off a huge portion of the losses from your Airbnb in year 1 against your W-2. Let me give you a real life actual example with numbers. One of our clients, a couple, came in with about $550,000 of a combined W-2 income. They went and they bought a short-term rental for about $540,000. We were able to qualify them for the short-term rental loophole. We performed a cost segregation and they were able to take about $160,000 write-off against their income. So let's say they were at a 24% tax bracket. That's about a $40,000 actual tax savings from their tax bill. Guys, this isn't gimmicks. This isn't scam. I'm literally just using the rules that the IRS already wrote. The key here, though, is qualifying. You have to log your time. You have to show that you materially participate. And you need to make sure that you invest into the right property with the right market that's actually going to make you money, right? I actually created a video right here that if you've never bought a short-term rental, go watch this video if it's your first short-term rental. But here's the problem. This strategy works, it's legal, but it is one of the most heavily audited areas in real estate. We have successfully defended over 5 audits that all had to do with the short-term rentals. But it's only possible to defend you successfully when the client keeps very good records. I also created a video if you want a deep dive on how to qualify for short-term rental, how to use a cost segregation, and I walk you through a real-life example literally on an iPad, so I'll leave it right here for you guys as well. So let's do a really quick recap, right? The Augusta Rule allows you to receive up to 14 days of tax-free rental income from your business, from your personal residence, or your vacation home. The S-Corp structure helps you avoid self-employment tax on part of your business income. It also doesn't get you as audited as the single member LLC. The short-term rental loophole allows high W-2 earners to offset those losses from the short-term rental against their active income from a high W-2. When you use all these together, you can significantly reduce or even eliminate your tax bill completely legal. Not because you're hiding income, not because you're breaking IRS rules, but because you're finally learning how to use the tax code the way it was written. And that's the difference between overpaying the IRS every single year and building wealth with confidence. Guys, if this video gave you a new way to think about the taxes, please hit subscribe. I post weekly strategies that helps business owners and investors save money, grow your wealth, and at the same time, stay legally protected from the IRS. And just a friendly reminder that this is not tax advice. This is just for educational purposes. And if you want to implement it, hire a good tax strategist or a good tax attorney. I'm Anna Klein, the tax boss, and I'll see you guys in the next video.